Good evening, folks. If you would please give me an audio check on Twitter. As soon as I get that, we'll get started. Again, I'm waiting on a confirmation via Twitter. If you guys would just give me an audio check, make sure everything's okay. Volume's okay, clarity's okay. Awesome. I appreciate that, guys. All right, so we are going to show our disclaimers again, unfortunately. As soon as we're done with that, we'll get right into it. All right, guys, you should be seeing a British Pound USD daily chart. The session did begin for this week, but we're not going to be talking so much about that. We may end up getting into it towards the end of the presentation, but for now we're just going to be talking about a topic. Hang on one second, I got one more thing I got to do before we begin. Hang on one second. Okay, forgot my drink. If I wouldn't have had a water next to me, I would have had to stop in the middle of it. So we're going to spend a little bit of time in regards to how I started as a trader. And I gave these guys some homework from a book titled Trading for a Living by Alexander Elder. And the book is, in my opinion, for the time it was released and for what's in it, not everything in it is, in my opinion, useful. but I believe that the psychology portions of it, I believe the aspects behind the triple screen approach is what began my understanding of a top-down analysis concept, and it gave me multi-time frame, I guess, foundation. But like anyone else reading that book, I tried to do the same thing by applying the MACD histogram, and we're not going to get into MACD histogram or anything like that, but I'm going to show you what I did using the premise of the triple screen and what the trading system was when I was trading initially in the commodity market. Now, before I go into this, I want you to understand that this was the infantile stages of me getting into technical analysis, and it was very retail oriented. Now, I'm only going to supply this now because a lot of people ask me, how I started, where did I learn this stuff from, did I used to trade with indicators, and there's going to be just a small little segment in this presentation that has to deal with indicators, but I'm only going to show that just to give like a historical perspective of where I came from, and then how to use all the market maker concept ideas in applying a triple screen type trading system. Okay, so the chapter in Trading for a Living, now again, I sent a link out. It's a free look, I guess you're going to say, for his book. I'm not trying to teach the idea of piracy. If it's insightful to you, support the author, obviously, and buy yourself a copy. If it's not that much money, you can get a Kindle version off of Amazon, relatively inexpensive. But nonetheless, we're going to skip over all the psychological stuff about that book, but I think that's the real good section in that book. Okay, but as it relates to the technical analysis, everything else except for what's shown in the triple screen, in my opinion, when this is all with respect, I think is useless. Okay, it's rare that you get a book that's chock full of useful information, and just for completeness sake, I'll just toss one out there that I believe that is a type of book that fits that bill, and that is Street Smarts. Okay, if you can get a hold of Street Smarts by Linda Raschke and Larry Connors, I think that is a real dandy of a book. And again, you can get a free sample look on it on the internet if you look hard enough for it. But again, support the authors because they did a really good work for the trading community, in my opinion. So for triple screen, I'm not going to show his book. I'm not going to put that on this video. I'm going to counsel you to go into it. But if you look at what was discussed on in that chapter, as I gave for homework, he teaches this idea of looking at 3 time frames. Okay, a higher time frame, then a lower time frame, and then an executable or trading time frame. Okay, and when he put this out years ago, it caused like a shockwave through all kinds of trading gurus, teachers, people that did seminars. We didn't do webinars back then because they didn't have the bandwidth to support it, but people that did live seminars and did books and DVDs and stuff like that, they immediately jumped on the bandwagon because they realized what he was teaching was a real quick and dirty way of looking at a top-down approach to trading. The way I teach top-down is you go through all of the macro market indications of whether or not the market is in a inflationary market or a deflationary market, and you've seen all that in my major market analysis template. You only have to do that once or twice a year. Okay, if you're really going to be gung-ho about it, you can do it quarterly. But when Elder put this out, I was subscribed to a service called CTS. Now, CTS stood for Commodity Trend Service, and it was headed up by Nick Van Nice and his father, and they were out of Dearborn, Michigan. And they did, in my opinion, the very best for commodity price charts. Now, they had to be updated manually by you, and I'm talking old school stuff, so you had to actually put in open, high, low, and close and all that business. But they eventually moved to an electronic format where you can download every single day updated version of each major commodity. And it would give you the weekly chart, the monthly chart, the daily chart, and usually it's like an hourly chart, a 60-minute for hourly basis. And I say all this because soon as Elder's book caught fire, Nick Van Ice came up with the CTS Trend Selector. And it was a downloadable service, or if you had a fax machine, you could have it faxed to you, and it would give you the monthly charts trend, the weekly charts trend, the daily charts trend. And while that was great, it didn't give a whole lot of trade signals, and he realized quickly that if he went to using the daily, okay, as the setup, and the trend being the weekly, the 1 hour being the executable stage, he had a winner, okay? And I quickly seen, without having him come out and say it, I knew right away what he was doing. He was using the triple screen approach to trend analysis. But I've already shared with you in a long, I guess it was 2010, I showed you the 18 and 9-day moving average, okay? And that still to this day is used for very many trend following funds, okay? Funds that follow trends, long-term macro trends, they use that gearing. It's an 18 and a 9, okay? And if you apply these averages, you will eventually get whipsawed around during consolidations, and you'll get whipsawed at trend reversals, okay? And the funds accept that. Now, it doesn't mean that the folks that are investing in these funds accept it. A lot of them get pissed off because they don't see the return that they hope to see. Because when the prospectus is sent out, or they sit down with the clients and the principals are sold on the idea that it does this or that, they twist the numbers, okay, and they average out the gains. So even though you may have 3 years out of the last 15 years that were absolutely barn burner, they average those gains across the entire spectrum of 15 years, and then they give you an average return. And the problem is it's not consistent enough. Okay, so I learned the hard way that, number one, by applying the MACD, it didn't help me. I never really seen a winning trade with triple screen, as Alexander shows in its book. I liked the approach of using the MACD as a histogram. I didn't like so much the moving average crossover type approach. I didn't like that because I was a fan of then, not now. Okay, you're watching this video now. I am not a indicator guy, but I'm giving you some history about where we're going to go with this. The momentum indicator I liked was the stochastic, and I used a 10-period stochastic, and that was my bellwether. I mean, I went to that for everything until I discovered the Williams percent R, which was more, in my opinion, more accurate. So I switched out. Instead of using a MACD, I used the stochastics indicator, and I applied it on a weekly chart, I applied it on a daily chart, and I applied it on an hourly chart. Okay, and I'm going to give you basically what I did to make money going long only, okay, in commodities. Now, I'm teaching this with the idea that you're not going to trade with this, okay? This part is not the useful part. I just want to show you where I came from, okay? So that way you can appreciate I went through the same thing you guys all did too. I didn't come out knowing all this stuff, it's the market maker stuff that's synonymous with me. I didn't have that from the beginning. So we're going to look at a daily, weekly, and an hourly chart. We're going to begin with a British pound, and I promise we'll spend very little time with all this indicator stuff, but I just want you to have it so you can see what I used to do. Okay, so when I had a weekly chart up, now I used Metastock. Now Metastock is a trading platform. Well, it wasn't a trading platform when it first came out. It was only a charting package for me. I wasn't able to trade through it, and then I eventually got with TradeStation, and then I had super charts for a little while too. These are old packages, but they were, at the time, they were the cutting edge. And when I opened up the weekly charts, we had to wait for the things to download at the end of the day. It was really cumbersome. You have no idea how spoiled you are today as a trader, because the information that comes to you is so easily and readily available. At a click of a button, you're there. At the end of the day, every single day after 5 o'clock, we had to wait for the data providers to upload all the data, and then we would download it in ASCII format. Okay, and if you don't know what ASCII format is, trust me, it's cumbersome, and we had to download this information, convert it so our programs could read it, and then it would plot these charts. Sometimes if the number was entered in wrong, man, that fucked everything up. You have charts with all kinds of stupid shit. You had to go in and get data off of somewhere else in terms of a source, and then go in and manually change everything. So you think you have it bad now, trusting what Forex broker to use and what high and low. Imagine that. How do you know? How do you know what your real commodity high and low is? And it's amazing. But nonetheless, I pulled up a weekly chart. Okay, and this is what I did. I put in and for the most part, you've all seen this. This is not the wrong. It's not the right one. Sorry. That shows how much I use these fucking things. I grabbed the wrong one. Moving average. 18. And we'll add the 9-day, or 9 period in this case. And we'll just use blue. Okay, and what this did for me was it gave me a direction to trade within, and I would only trade in the direction of where the averages were moving in the same direction. Okay, and the 9 period, if it was below the 18 period and it was opening up or stacking, in other words, it's opening up and they're both pointing down, I'm going to look for going short only. And this is a weekly chart. Okay, so when I had this condition, I would look for short selling. Now, it doesn't tell you much by itself. This gives me a directional premise. Now, before we go into all this, it's important that you understand, and I talked a lot about this in the trading plan development series that I did years ago. Many folks that email me will ask these types of questions. I have a lot of tools, I have a lot of concepts, a lot of information, and where do you go with it? Okay, and one of the easiest things you can do as a trader, okay, to simplify your own trading is you have to identify 3 things. It's a real simple process. Number 1, you have to develop a premise. Now that is either going to be directional bias, it's going to be a volatility understanding. In other words, what market environment are we in? Okay, this is all stage 1. In other words, you're looking at a market selection. Okay, you're looking at a market selection. In other words, what gives you your trading idea? Where does it all begin? That's where you're starting at. Now, if you start as a new trader and you come into the marketplace, for instance, and we're going to use the asset class we primarily work within, the foreign exchange, there's a plethora of all types of currency pairs and crosses to trade with. The problem is because you think that there is a million different opportunities because there's all these different currency pairs, they're all generally doing the same shit. That's the problem you don't understand as a new trader. They're all working generally in the same underlying market. The conditions that are prevalent right now, they're all being impacted by that same thing. You're being lulled into believing, just like I did when I first started 23 years ago. I believed that the indicators were pushing price around, so I would be going through all the charts looking for indicator signals, and then the price would have to submit to the indicator, and it's horseshit. It doesn't work like that. You as a trader, you're going to have to start with a selection mode. Okay, this is the module that begins all of your trading. It doesn't matter what trading style. If it's well, I'll just keep it in my frame of mind because we can easily go down a fucking rabbit trail and we'll turn into a rant session. The very first thing you're looking for as a trader is what frames or builds the premise or the idea for you taking a trade. Are you a buyer or are you a seller? Okay, in simple terms, are you a bull or a bear? Without having that as a beginning basis point, you have no idea what you're going to look for trade setups. You have to have a stage. Okay, Larry Williams, my original mentor, when he taught commodities, okay, and his resources and such, and when he went and did his inner circle workshops and all that, the first thing he starts talking about when it comes to trading systems or methods is you have to have a selection tool. Now, when he said that, I was thinking that means I gotta have every fucking indicator that I have on Metastock on my chart, and I would have every moving average, every oscillator. I would have everything on there. Everything would be on there. GAN would be on there. I have no fucking idea what GAN's doing on my chart, but it's on there. And I'm looking for something to give me something that lined up with what the gut of me as a trader, brand new, not knowing anything, was telling me. I would look at price. It was going up. Okay. I was thinking, okay, well, it's going to keep going up. And then I would be buying the high. Then I'd go in, I'd be looking at the price, it'd be going down. Okay, well, I want to sell it now because it's been going down and it's been going down for a long time. So now I'm convinced it's going down. I'm going to sell short, and I'm selling the low of the market move. When I look back now as a more mature trader, okay, and understand really what Larry was implying, when he said that you're looking for a stage, okay, let's give some scenarios where this could be useful. For instance, the long-term chart. Whatever your long-term basis is, it may not be a weekly chart. For some of you, a daily chart is your highest time frame you're considering. You're not worrying about what a weekly and monthly chart looks like because you're a very short-term intraday scalper, and it's not necessary for you to be looking at a monthly, yearly, okay, or even a daily chart. I'm sorry, well, we just said daily would be your time frame, your highest time frame. But you have to have a time frame that's going to be relative to what you're trading off of, bullish or bearish. Okay, and we can apply all types of things to it. It doesn't have to be the weekly chart with moving averages. Okay, it can be COT. Are the commercials bullish or bearish? Are they at a heavy net long or are they heavy net short? There is your stage. That's your beginning point. Are you going to be a bull or a bear based on that? Okay, so don't think you have to align yourself initially with indicators like this. I'm just giving you what I started with way back 2 decades plus ago. Okay, the benefit of this type of approach here, and that's why I still keep it in my original work, from 2010. As a new trader with no idea of what institutional order flow is, how the market maker sell and buy profiles take place, it's very easy for you to get caught up on the lower time frames and the noise that you see, and it's noise only when you have no idea what the fuck you're looking at. When you're looking to lower time frames, if you have no understanding what it is that you're specifically expecting to find on these charts, then yeah, you can be very easily lulled into doing something that's completely the wrong thing to do. And that's generally the repeating phenomenon you see with retail neophytes and people that consistently lose money because they have never learned how to trade. The larger time frame, okay, you're going to be using that in relationship to your trade selection. Now, for this teaching, for this trading method, okay, we're going to be specifically dealing with the weekly chart. Now, again, for a second, imagine the chart not having the moving averages on it at all. And imagine we're plotting commitment of traders on it. Commitment of traders being net long and net short, okay, by the commercial traders. That would be your basis of whether you're not a buyer or a seller. It doesn't have to be these moving averages, okay? But you need to have something on the higher time frame chart, and we're implying that the weekly chart's going to be it. You have to arrive at what makes you a bull or a bear. Whatever that is, it can never change. Whatever those parameters are that build the idea that makes you a buyer or a seller, that must remain constant. Otherwise, you're not going to have measurable results. That way, number one, you're never going to have the confidence to stick with it, okay? And also, you won't be lulled into abandoning it just because you're having temporary loss of traction and taking losses, because you're going to absolutely take losses. And I'm going to throw this in here. I gave some teachings on the ICT ATM method, and automatic teller machine is really what that means. It's basically like you go to an ATM machine, take out cash whenever you want. I have a lot of people trying to back test that based on just what was discussed in the video. It was a primer to get you prepared to start looking at it, but unless you understand what you're looking for in terms of turtle soup, market structure, okay, if you're looking at every swing high and every swing low, and this is what I said in that presentation, every swing high and every swing low is not equal. They're not created equal. There are ideas behind them that you have to expect to ferret out all the ones that most likely won't work. And I'm going to say this, and I mean this with love, okay, because I know a lot of you guys are really doing some really extensive back testing. Listen to me. If you torture the data on anything, on any trading system, it'll tell you whatever you want it to say. But on the flip side of that, if you trade with the ideas with the right context behind it, you get far less trades. And the trades that you get are barn burners. You're going to have losing trades. And what's going to happen is you're going to end up looking at these things just like I seen on Twitter. He's immediately going to the ones that work because it's right there on his chart. No, you don't even know what I was doing. You were already commenting before I even presented what I was discussing in that video. Just like some of you are already probably chomping at the bit to say something about what I'm going to show you here. You have no idea where I'm going with it. None. I'm already on the other end of it. I know what I'm communicating to you and how to get you to the understanding I have. But you're not going to jump from where you are to where I am in one video presentation. It's going to have to require you to go through some things and learn it and apply some things and add, more importantly, the filters. The filters is what you're missing, but you're not going to appreciate the filters once I give them to you because you haven't seen what you're doing right now. You're doing the very beginning thing that as a prudent trader should do. You're looking at the raw data and it looks like it doesn't work. It looks like there's no fruit behind it. And that's exactly what you should be seeing. Then when you apply the filters to the ATM method, then all of a sudden you'll have a far less amount of trade, but the trades will jump off of the chart at you. But without having context, and I'm going to give this to you in kind of like as a tangent, think about what I'm sharing with you today and go back and look at your data when you studied the ATM method, looking at the swing points. When you do this, your results are going to dramatically change. Okay, but there's still more past this, but I'm giving you some foundation. But going back to this and keeping it germane to our discussion today, our weekly chart is our selection time frame. Just like on Alexander Elder, he's selecting the weekly chart. That's his trend, his long-term trend. Okay, his intermediate term trend was the daily chart. And then there is a intraday chart, and it could be a 15-minute time frame, it could be an hourly chart. We're going to primarily stick with that. The weekly, the daily, and the 1 hour chart. So if we have a condition in the marketplace where the averages, and we're going to use this as our beginning point. I'm not going to use the MACD because I believe I'd be ripping off Alexander's book, and I'm not trying to do that. The idea behind it, we're going to sell the idea that it's very useful, there is merit to it, but you have to understand a few things, okay? So what we're going to do is we're going to outline the times. Now this is going to look just like a video you've probably seen me do years ago. And this is going to build long-term, okay? Let me slow down a little bit. When you as a new trader, if we were all in a classroom setting right now and I asked you a question, and the question would be this: how many of you are struggling with the idea of what you should be doing as a buyer or a seller right now, or basically daily bias? You'd all raise your hand. You all would raise your hand. If I knew that, Michael, if I knew that, then trading would be easy because I understand order blocks, I understand Power 3, I understand the weekly range, I understand buying or selling on the Tuesday or Wednesdays with London Open. I believe that I'll be profitable then. Okay, and you all collectively have that same question, and you've created it in your mind as a roadblock. If you go back and go through all the material, okay, the main thing I've always consistently said is everything you're looking for is on the higher time frame chart. Now, when I say that, why does it go in one ear out the other? Because you're looking for, tell me when to get in, tell me when to get out. See, you're not really asking for, give me the daily bias. You're asking for, tell me when to get in, tell me when to get out. That's the easy part, but you've amplified it and made it a big mountain of uncertainty. The thing that you should be primarily focused on is, what is the higher time frame charts telling you? One of the easiest ways as a neophyte trader to get yourself acclimated to this idea and not have a system that doesn't take losses. Okay, you're going to have a losing system regardless of who you are, me included. ICT is not exempt from taking losses. But to have a foundation to understand what it is that you should be doing as a trading system or method, okay, you have to have something you keep going back to as your selection tool. Your selection tool, or the trading stage that you're going to operate in, being a buyer or seller, that has to come by way of a higher time frame chart. Weekly's it. Okay. Now, if you're an ultra short-term trader, intraday scalper, the daily chart would be that for you. Okay. And then you would have the hourly chart as your trade setup, and then you would use a 5-minute chart for your execution. That's how you can use it. You can frame this however way you want it. You can scale it, but we're going to stick primarily to short-term trading for this teaching module. Now, it can be applied as a day trader's idea, but it's really meant for like a 2 or 3 day hold. So have that in mind when we're discussing it. So now we have two areas in which the market is shaded. Okay, and what I did was I shaded where the blue or 9-period exponential moving average crosses below the 18-period exponential moving average. Okay, let me double check, make sure I got that exponential. No, I have it on simple. Fuck it, just to prove that it's not that big of a deal, we're going to keep it with simple. It's not going to be exponential. So simple 18 and 9-period moving average. So when the 9 crosses below the 18 and they both start pointing down, when that condition is there on a weekly chart, we believe that that direction probably will stay in motion for a long period of time. Okay, the question is going to be, how long is a long period of time? I don't know. You don't know either. You're not going to know when you take the trade. So stop asking questions. You're never going to have the certainty in knowing. You don't know if this is going to go down here and come right back up. You have no idea it's going to happen. That's what you are all trying to avoid. You're trying to avoid the uncertainty. You're trying to avoid what every trader has to contend with, the potential of being wrong. You can't worry about that. Otherwise, you're never going to take a trade, and you're never going to be able to deal with it. Okay, you're going to have to take losses. But if you keep your losses small, but let your trade payouts be 3 to 5 times the potential loss, you'll make money. You will do very, very well. And you don't need to have a lot of trades. And this is what we're going to teach tonight. Very little trade setups based on a higher time frame premise and sticking to that. Don't worry about what anybody else is doing, what other system's happening right now, whatever other traders doing right now doesn't make a difference to you. You want to start as a brand new trader doing things like this to build repetition, to build continuity, to build a history of you doing something that you can measure. And it's going to be on the weekly chart. Just like on the triple screen, Alexander Elder suggested that using the weekly chart, that's your trend direction. You're only going to be trading in the direction of that weekly chart. Now, he used the histogram, which I'm not going to show here because it's too choppy in nature. And in my opinion, it will give you less information than if you did something so simple as what we just showed here. And the reason why I know this works is because I know fund managers that use this. Okay, if you sat down with these folks and they showed you what they were doing, this is their long-term trend system. It's not trend lines. Okay, trend lines are bullshit, but these moving averages act like dynamic trend lines. If you look at what's going on, price will find support at that as it goes up. You see that? When we drop down into the daily time frame, you'll see that the 9 period and the 18 period do it even more extraordinary way of providing dynamic support and resistance, much in the same way that you would expect a diagonal trend line to provide resistance and support. These moving averages do that very thing. Okay, so we're going to go in, we're going to look inside just this section right here. I'm not going to study this here. You can do that on your own data. But in here, we've identified when the market has seen the 9 period below the 18 period. When this occurs, what we've done is, and this is probably a little too ambitious going over there. It should be right there. Okay, so in this shaded area to this shaded area where it crossed back above it, all in this shaded area here. Let me take this one off. Okay, all here, you're going to do some back testing on it and show you some things that you'd be looking for. Now, again, the weekly chart is where you build the idea on. Are you a bull or are you a bear? Are you a buyer or are you a seller? Whatever this time frame tells you on the weekly chart, it doesn't fucking matter what I talk about on Twitter. It does not matter what anybody else is talking about in the ICT forums. It doesn't matter what CNBC is saying. It doesn't fucking matter. You're only going to trade in this direction only. There's nothing else that's going to happen. This is what you're going to do. You have to submit to an idea and stick with it. Come hell or high water, this is what you're doing. Okay? And it's on the weekly chart. So now what we're going to do is we're going to drop down into a daily. And this is where the trade setups occur. Inside of this green area, this is where the weekly chart crossed bearishly. This is where the weekly moving average crossed bullishly. For a second now, let's take our mind off of the moving averages. We'll come back to it in a minute. But for right now, let's just, well, fuck it. I gotta take it off because it's gonna drive me nuts too. And I'll keep looking. I'll keep looking at it just like you probably are. So hold on. And we'll be able to pop them up when we need them again. Okay, so we've identified an area where the market on the higher time frame, we're going to be a seller. We only want to be a seller in the British pound when the weekly chart shows a 9 period drop below the 18 period simple moving average. Now, I personally used an exponential moving average for clarity's sake and completeness and honesty. That's what I used. But to prove the point, it can be a simple moving average. It doesn't make a difference. Now, why? Why is that? Why does that build an idea? Okay, why is that our selection tool? Okay, well, for instance, when we're looking at a weekly charts don't go up and down, up and down, up and down in very short little peaks and troughs. Generally, the long-term time frame of a weekly chart sees very long, protracted ranges that keep going for a while, up or down. Very rarely do you see weekly charts stay in a trading range environment or a consolidation. That's the reason why large trend following funds use that time frame, because they need time to move money into their positions and move out of their positions, and they can't operate on what we do as smaller traders, where we can operate inside these smaller time frame intraday charts. Okay, large funds can't do that because they have to average in and average out on their positions, because they have managers to oversee their execution, and they have to stay within the guidelines. Whatever that fund operates in, there's managers that are their job is to make sure that that trader that's executing on, they're sticking to that rule. Some funds, their fund manager is the operator behind it. But there are larger funds that have managers that make sure that the traders behind that fund are doing the very things that are expected. So if they're out of spec, they can be, number one, reprimanded, or if they're grossly out of range, they can be fired. Okay, so without all that, let's just go back to what we're discussing here. This green area is where you would be primarily only looking for going short. Why? Because your weekly stage or your selection tool tells you that you're a bear. Okay, you're only looking to be a bear. If the averages on the weekly chart were 9 above the 18, you would be looking only to be a buyer. Okay, by itself, it does not mean jack shit. It just gives you the beginning points. What are you looking for? Because right now, as a new trader, if you're watching this, you don't know what the fuck you're looking for. You have no idea what you're looking for. None. Zero. You're chasing indicators. To remove all that uncertainty, to give yourself something specifically, what you're aiming for, when you sit down in front of these charts, you have to have a foundation. That foundation leads you to make a trade decision. But before you can take a trade signal, there has to be something behind the idea that bolsters your confidence whether or not you're either buying or selling. Otherwise, what are you doing? You're reacting. And you cannot be a reactionary trader unless you're an ultra short-term intraday scalper and you know what the fuck you're doing, and most people can't do that anyway, so let's go back to the discussion here. You're going to be leaning heavily on the weekly chart because our belief is, and if you look at weekly charts on any asset class, you'll quickly come away with this is the truth. Weekly charts tend to have very, very long-term trends. Very rarely do you see them going in consolidation or remaining in a consolidation very long. Once they move out of consolidation, that trend that you see usually lasts for a long period of time. And it takes an entire week for each candle or bar on the weekly chart to form. So that means there's a lot of time behind these moves. So what does that mean? It means it's going to be very little in terms of quick reversals. Okay, it doesn't mean you won't get caught in a reversal because that's usually what happens. But when you know that you see a reversal, chances are when you get burned at the end of the trend, you won't be confused about whether or not you should be buying or selling based on that weekly chart anymore. You'll move to the sidelines. Okay, it's going to give you very, very little trades, but the setups are going to be much more, well, much better quality type setup. So now here we have the condition inside this green area is where we're bearish the entire time. Now this is taking a great deal of liberty in terms of hindsight, but this is how you have to learn it. You can't go forward without having a basis on what you're expected to see. So in this time frame where it's all shaded, we're now in a daily time frame. So we're going to be looking for areas in which that we would be expecting the signals to form for our trades. So what does that mean? Well, the stage is that we're bearish. So we're perpetual bears. As long as the weekly chart is implying that lower prices are expected because the 9 period is below the 18 period on the moving average, we are sticking to only going short. Now, when we go short, it has to be on the heels of something technically lining up with the daily chart. Now, let's go back to the thought process that Triple Screen taught in Alexander Elder's book. The weekly chart, if the trend is down, and if the daily chart has a swing going down, that you can't do anything. You have to wait. But if you see the weekly chart going down and the daily chart goes up, then you're looking for a sell. Now think about that as a new trader. It probably doesn't make any fucking sense to you because it didn't make any sense to me when I first saw that. I'm like, what? What if it's reversed? The daily chart might be, keep going up and the weekly chart didn't catch up. See, that's the problem with being a new trader because you're thinking too much and you're attributing a lot of your ignorance to the marketplace where it has no basis. It has no business being in it. You have no idea what you're doing, so don't bring your preconceived expectations or notions to the marketplace because you will not make money. If you knew how to trade without trading, you're a fucking genius, and no one's done that. No one's ever going to be able to do that, okay? So what am I saying here? Inside this shaded area, every time that the market has a rally or it trades up, okay, or it swings up in price, that's setting up a sell signal. It's giving you the sell signal based on the context or premise behind the market is you're looking primarily for bearish environments. Okay, in other words, you're only focusing on going short. The only way you're going to see that occur in terms of a trade setup is if the daily chart is implying that it's cycled up. In other words, there's a retracement. Hang on one second. Now think about what this sounds like, okay? For those of you who are familiar with me teaching day trading, Okay, the premise for day trading is you're going to be a buyer or seller, but then you're going to have what? You're going to have an opportunity. If you're bearish, there's going to be a Judas swing. It shoots up. Okay, so you're going to be selling near the high of the day. Well, think like that in terms of the daily chart. The weekly chart is giving you the daily bias, just like in day trading. But in here, we're looking for the bias to go short only when the market rallies up. Okay, so when the market rallies up, then you're looking for areas where you're going to be going short. Now, what I used to do, now I'm not doing this here because I'm not trying to teach indicators, I would look for the 10-period stochastic to give me a bearish divergence. In other words, it's going to make a higher high than a previous high. And if it did that on the daily chart and the stochastics failed to make a higher high, everyone knows what a bearish divergence is, okay? If it does this on the daily chart, I would go short. In other words, I'm looking to sell right then and there. I would go into the hourly chart and see the same thing, looking for it to be overbought. Fuck the indicators. You don't need all that stuff. Trust me, none of that shit's working for you, okay? It's going to be hit and miss. I want you to think about the idea of when the market rallies on this time frame, the daily, when the weekly's bearish, when the 9 period's below the 18 period, you're in only going short mode. The daily chart, when it rallies up, every time the daily chart rallies up, that's the same thing as a Judas swing. It's manipulation. The market's going into a protractionary state that's counter what its long-term trend is. What it's doing is it's building in a premium so folks can do what? Buy it at a premium, and then they're going to discount the market. Okay, and the market goes lower. Look at all the rallies that took place inside of this shaded area. Okay, you have this rally here, you have this rally here, you have this rally here, you have another rally right here, you have another rally right here, a small little rally in here, you have a rally in here, small little rally in here, you have a rally here, another rally here, another rally here, another rally here, another rally in here, and ultimately we saw the market go out of our selection basis based on the weekly chart, because now we've gone outside of the weekly chart's range in terms of when the 9 period is no longer below the 18 period simple moving average. So now we cannot be taking sells now because the weekly chart says we can't do it now, and we have to wait. But all up to here, we could be looking for sells. Now I know what you're thinking. Well, what if you would have sold here? And what if you sold here? And your stop was up here? You would have lost money. You're fucking right. You're going to take losses. Stop thinking like that. That's a weak-minded retail's perspective that you're afraid to take a loss. Professionals take losses. They're small, but they allow their wins to be larger in magnitude than their losses. Stop trying to find fucking unicorns. They don't exist. Okay? You're going to take a loss. No matter who you learn from, whatever method is, whatever the principle is, okay, whatever that discipline is as a trader, you're going to absorb and weather losses. You can't avoid it. Trust me. I have never made it to that point where I trade without losses. You're not going to fucking do that, okay? So stop. I know exactly what you're fucking thinking right now. You're looking at this and it's fucking worrying. It's worrying you. Well, look at this. I would have took a loss there. And you're only really focusing on how you can avoid losing money. Right now, if we were all in the room right now, I asked you all to raise your hand. Guarantee you, right now, you're looking at where it didn't work. That's what you're doing. You're looking for where it didn't work because you think I'm selling you the idea where it only worked. You need to stop toxic thinking. That's exactly what you're doing. Okay? I haven't even given you the filters yet. I haven't even gone into the ideas behind when you take the trades. You're already coming up with an opinion about it or why it doesn't merit your study because it's going to give you a loss. Stop fucking thinking like that. I'm telling you, that's going to be the biggest problem, and it's you in the mirror. You're the biggest problem in your development as a trader. Not me, not the next mentor that you go to after me. Doesn't make a difference. You're the biggest impediment. All responsibility is laying on you. And it's all easily fixed by just simply saying, I don't know what the outcome of this trade is going to be, but I'm going to stick to the rules and see what happens. Keep my risk small. Look for my payout to be larger, 3 to 5 times bigger than I'm assuming in a risk, and then the numbers will take care of themselves. That's trading. That is trading. It's not fucking fast cars, Lear jets, and beaches. That's not what this is. It's doing something consistently over and over again that has a statistical edge that pays out over time. And if you continuously do this and you allocate money in the same fashion each time, you're going to take losses, but you will make more money than you lose. If you deviate from the rules, you're going to fucking lose money. You're going to do shit outside the rules, and you're going to blame the rules that they didn't work, and you're going to chase something else. And you're going to do something else, and it's not going to follow that rule, and you're going to be a loser perpetually. Trust me. Retail stuff, if you understand how to use it the right way, not how retail uses it, you can make it profitable, but not in the way that they teach it to you. If that went over your fucking head, trust me, stick around and it'll make more sense to you. So now looking at what we have a range of time, not range in price, we have a range in time where we want to be focusing in on being a seller. But the weekly chart gives us that directional premise. When that 9's below the 18, we're sellers only. So we have to see a rally on the daily chart. It must rally. It has to rally, or we do not have a fucking trade set up. We cannot take a trade. Absolutely. It doesn't matter if the weekly chart's saying it's sell. It doesn't mean just because the weekly chart's a sell, every fucking day is a sell short day. It does not mean that. Here's where we're going to be doing timing. Okay? So you have the first stage, which is the higher time frame. That's selection. Are we a buyer or are we a seller? When we know what we're doing relative to that weekly chart, when the 9's below the 18 simple moving average, we're a bear. When they're both pointing down, we're a bear. When the 9 goes above the 18 simple moving average and they're both pointing up, we're a bull. We only buy. That does not mean the very next day go into the market and take a trade. We have to look at this time frame next. It's the daily chart. Now, what specifically are we looking for on this daily chart? If we're not going to be looking at indicators, because I don't fucking teach indicators, what are we looking for? What's the idea behind this? What gives you the trade set up for timing? We haven't talked about execution. That's going to be on the hourly chart. Stop jumping ahead. You're already jumping ahead. Stop. Keep the idea right now germane to this time frame. Daily. We're looking for the price to rally. Wait, how far is it supposed to rally, Michael? Is it just a one-day rally we're looking for? Is it a two-day rally? Is it, do I have to wait for a harmonic pattern to form? Do I have to do all these Fibonacci stuff? Do I have to have an OTE? Can it be something else? What specifically can I do? What do you want it to be? Here's where you can add in your personal flair, your personal touch on your trading. The weekly chart gives you the premise. Are you a buyer or are you a seller? The daily time frame, you have to determine what is your setup. What's your setup? Now, I'm going to give you a couple things because I want you to understand how universal my things are. And if you are a retail indicator guy or gal, and you have to fucking have an indicator on your chart, at least you'll know when to use them right. Not that they're right all the time, but there are times when these indicators are going to give you a signal, but most people don't use those signals. They're doing something entirely different because they don't have a higher time frame premise behind their trades. But I'm going to ask you a question. Across the spectrum of this green shaded area, okay, I want you to think about a few things. Everyone knows me for the optimal trade entry. That's just a standard 62% retracement to a 79% retracement, okay? And specifically the 72.5. I'm sorry, 70.5 level. Good grief, 72.5. 70.5 level or sweet spot for OT, optimal trade entry, okay? Every time we have a high, in here and price trades down, we can't take a trade going short when the market's going lower. Okay, we have to see price rally. So when the market starts to rally up, okay, we know that there's what? We have a range in here that it's going to most likely want to fill in. Okay, if we add, now I'm going to give you a couple different things just to prove how looking at the market like this gives you context. And this has got to get changed because that's not a good color. Okay. Now, when we look at price like this, we have a high, the market goes down here. We cannot sell until the market starts rallying. Okay, the market starts to rally up in here. Okay, now watch what happens. The market hits a Fibonacci level or 50% level in here, or equilibrium. By itself doesn't mean dick. But if you look over here, think about the things I've taught with Market Maker. We have a small short-term high in here, and you have a down candle right there. See that? Market rallies up, takes out a previous swing high. This is a breaker. What makes it a breaker? Because it took out the stops right on this swing high, rallied up, and then gave up the ghost and traded lower. So the market hits this level right there. As soon as it hits this level right there into this breaker, then at that moment you can drop down into an hourly chart and look for things to execute a short position on, because we have a setup here with the long-term premise in agreement. Now, I already know what you're thinking. Well, look at this big candle here. I would have got my ass handed to me, Michael. Stop for a second. Think. If it hits it here, and this is a daily chart, you have one day where the signal hits. Looks like it was a weekend in here. Then you have a start of another week in here, and it's holding and pausing. And then it comes up here and does what looks like, I don't know for certain, but it looks like a Tuesday where it opens, rallies up a little bit, and slams down and has a move. Now, if we looked at this candle, let me put this so we can see. Right in here, we're going to say that we hit this level on the close, 153.32. Okay, we're going to play devil's advocate. Say we sold at 153.30. Okay, we sold short at 153.30, and I don't know what that level is going to be because we're looking at the daily chart, but I'm just going to give you the real wide range of what it could have been. And then we have a high here at 53.85. So we potentially have 55 pips in question in terms of that has to be fine-tuned. But that's going to be done on an hourly chart. That's your executable time frame, the hourly chart. Right now we're just looking for the setups. When price hits that level right in here on this day, that's when your trade is executed. The setup is here on this day, on the 10th. I'm sorry, what is that? September 10th, 2015. That day would be your trade setup. Your entry or execution is going to be on the hourly chart. Okay, but basically what you're going to see is the same thing you're looking for on the daily. It's the same thing you're going to be looking for on the hourly chart for execution. And that's going to be by way of whatever your setup is on the daily, you're going to scale down to an hourly chart, and whatever that same setup is that you trade with on a daily chart, it's the same thing you're looking for on an hourly chart because price is fractal. You're not looking at a bearish divergence of an indicator on a daily chart and then looking for something else pattern-wise on a 60-minute chart. You keep things the same way. Whatever your trading pattern is, your trade setup, that's going to be the same pattern you execute off of on the hourly chart. So what do I mean by that? Well, I'm using this setup here. We have a breaker, and it hits equilibrium. That's an area where you can take the trade. This day right here, you'll be looking for a similar type of formation. It could be a breaker. It could be a bearish order block. It could be optimal trade entry like we're showing here. Okay, but whatever the trading setup is that you adopt, that you want to go with, that's the same thing you're looking for on an hourly chart to get into the entry, the execute on it. Okay, and I'll give you a couple more examples just to keep your gears turning, because I don't want you feeling like I'm giving you specifics. Do this, and this has got to be the only way you do it, because I don't want you to think that way. But I do want you to adopt whatever criteria it is around these things I want you to stick to it and work with it for 1 full month. That's why I said every month we'll sit down, we'll have a trading system or method, and we'll adopt one, and we'll trade it live. Okay, so with this week, I want to kind of like use these ideas to go forward and see, well, and share with you rather, the results of it, and you can see when it works, when it doesn't, and over a period of time, it's profitable, and that's all you need. Start there, and then you can amplify that, and you'll become way better of a trader than you ever imagined. But you have to start somewhere, and none of you have started at the right place. You're all looking at intraday charts, and you got to go back out to these higher time frames. So when price comes down here on this day, the low is 52.03. So right away, that's 53.30 or thereabouts, worst case scenario. Okay, say we had a 55 pip drawdown. Okay, I know you're probably thinking that's more pips than I would have with a ICT trade. Well, not if you're trading on a higher time frame like this. Okay, so keep things relative. But say, for instance, that we used the worst case scenario and we got in around 153.30 without having any reference to the hourly chart. I'm taking a great deal of liberty in saying that if it's 53.30. I know it's not 53.30. It's going to be a higher price because we're not dropping down the hourly chart yet. But we're going to give you this worst case scenario. Say we shorted it at 153.30. The range takes us down to 52.03. So there's more than 120 pips available to you there, just in a couple days. Is that not well above what I average on a one-shot, one-kill basis? I'm looking for an opportunity to make 50 to 75 pips a week. That's all I'm looking for, guys. That's all I am trying to do on a weekly basis. I know it's hard to believe because you've seen a lot of 200 pips moves and 500 pip moves and stuff like that. That's not what I expect to make every single week. If I get it, great. But that's not what I'm aiming for. I'm going to get the low-hanging fruit. That's exactly what professional traders do. I know I can find a trade setup that's going to yield me 50 to 75 pips every fucking week. Every week. That's why I'm not worried about not trading all last week. 1 week of not trading is not going to break me. It's not going to break me. It's not going to concern me at all. And it's not going to concern you either once you identify that trading is a craft that you can harvest setups in all the time and you don't have to be rushed to get in there. Now think about what this is doing. This is actually building a great deal of focus, discipline. It's giving you rule-based ideas. You cannot just willy-nilly a fucking trade. You have to look for specific things. Now, when it comes down here and trades right back into, see this down candle right here? This is the swing lows bullish order block. The high of that candle comes in at 152.12. The low on this candle comes in at 152.03. So you know that there's a reason to take profit when it gets back down here. Why? Because this is your trade selection time frame. So you want to get paid at this time frame's levels. It's order blocks. Or if you have, well, let's not talk about indicators because I really want you to not be an indicator trader. But in here, then we see what? Price rallies again. Maybe this took you by surprise and you're cussing and ranting and raving. Fuck ICT. This motherfucker didn't give me anything to catch this long move. I missed this. This is the biggest range of the whole week. This is stupid. I don't want to trade this. I missed this one big move. And that's going to happen the rest of your trading career, no matter what you use. Think about everything you've learned in the past. There's big moves that's taken place. But because you hear me, and I spend so much time on a one-on-one type setting with you, when you're listening to this video, it's essentially a one-on-one setting. You just have the luxury of pushing mute, or pause, or fast forward, or rewind, or never even watching the fucking video if you don't want to. Doesn't change the fact that the information is being communicated to you. It just is a different type of learning experience. So you have attributed a great deal more of significance behind what I teach you because it's more of an interaction. You're going to miss moves, man. You're going to. And when you see these big rallies up like this, that's great because what does it do? It's giving you another setup. Now we traded up into optimal trade entry between 62 and 79% retracement level. Look how many times it hangs around the sweet spot. By itself doesn't mean dick. Doesn't mean shit. Means absolutely nothing by itself. Keep on rolling through some candles. cut through this one, Sam. And right over here, we have what? The swing high, the up candle, bearish order block. Price should hit that opening price right there. Hit, hit, hit. Well, what is it telling you on the daily chart? Because this is your trade idea. If it's doing this, what are you trying to do? You're trying to sell when it's hitting that. Okay? Well, you hit it. You're in a trade. You got to stop above whatever level you arrive at on here. You got to contemplate whether or not that your trade's going to be either a long-term trade or it's going to be a short-term trade. A long-term trade is going to be a week. A short-term trade is going to be 1 to 3 days. And you're probably saying, well, what's the difference? The long-term weekly, you're going to take some of it off and you're going to leave half on. Double. It's like 2 positions put onto it. So, you're going to enter into 2 trades, essentially doing the same thing. Selling, if you're going to trade 2 lots, you'll sell 2 separate trades at the same time. That way, you can take one off and leave one on and not even worry about it. Double tap, basically, if you know what I'm talking about, the old system of just doing 2 trades at one time, peeling off one at a logical area of profit. Well, you're thinking, probably looking at this, thinking, oh, it took a long time, several days in here before the market actually moved down. So what? So what? You're thinking like a day trader, and that's gonna squeeze on your nuts as a day trader. You're not gonna feel comfortable, and that's the reason why you have to determine what type of trader you are. Because if you can't sit through this, you can't be a short-term trader, and you sure as fuck can't be a position trader because you're gonna see a lot of that type of stuff happen. So if you're ultra short-term in your decision making, you're a day trader, and you're gonna have a hard time trading this approach. But you can still do it with a 4-hour chart, and then an hourly chart, and then a 5-minute is your execution. It's all scalable, guys. It's all scalable. Hang on one second. All right, so we have a classic ICT optimal trade entry in here, but really just going back to a bearish order block, closing in the range. Okay, so we have a setup here. Every time that price trades up into here, we're going to go down to a lower time frame hourly chart and look for a sell to execute on. Selling short on the hourly chart. Okay. Take this off, take this off. Price eventually moves lower. Who cares? We're not going to consider anything there because we're not looking at the lower time frame yet. We're just giving trade setups that are in uniform with the weekly chart suggesting only selling short. The market rallies again one more time in here. Actually, let me go back to this one. We have this swing high here, and the price rallies up. Let's say you're not going to use the optimal trade entry. Okay? Say you're not going to sell at bearish order blocks. You're going to be a turtle soup trader. You're going to be only trading on raids on stops. I'm going to tell you this. If you do this, you're going to trade just like I do. Because I'm looking for a stop run with a hit into a bullish order block. That's the best optimal entry you're going to ever fucking get. And if you get optimal trade entry on the fib to overlap with it, great. But that's not why I'm taking the trade. The strongest setups are trading in this type of environment where the weekly is suggesting lower prices. Okay. Before I end this video, I'm going to go back out on the weekly chart and teach institutional order flow, so you don't have to use the moving averages, but I'm going to show you the moving averages because I need you as a new trader to have something to work with initially, because you're not going to understand order blocks, you're not going to have all that behind you. Moving averages are visual, they help you, okay? They're like a little crutch, but you can't rely on them entirely because they'll be problematic for you. But when you understand institutional order flow, it makes it a lot easier. So when we have a swing high, okay, again, this is to assume that you're not going to be a optimal trade entry or bearish order block trader. Every time you see a short-term high rated or rallied above, okay, and this is where you guys that are getting all ass hurt over the ATM method, saying it's got a lot of losers in it, okay, you haven't applied any of the filters. No, Mike, sit still. Good grief. Okay, and okay. All right, so now, same premise, same idea, weekly chart, all in the shaded area. We're only going to be looking for sells. Okay, every time there's a short-term high, when price rallies above it, we're anticipating that being a turtle soup. That means at this short-term high, your trading pattern or your trade setup is you find a short-term high and you want to wait for price to rally through it. When it does that on the daily chart, that's your sell scenario. That's your trade pattern. You want to get short. Then you're going to drop down into an hourly chart and look for the same thing to occur on the hourly chart. A short-term high that's being breached on an hourly chart, and you're going to sell right there at the time of day. What time of day is that? London or New York open. That's it. Same thing in here. We have a short-term high in here. We wait for price to rally through it. That's turtle soup. You want to get short when the hourly chart does the same thing. It runs and breaches through a short-term high. This is your trading pattern. This is what you're going to trade on. We have a short-term high here. You're going to wait for what? The daily chart to rally, because that's what the rules imply. You have to see the market rally on the daily chart. When the weekly is implying lower prices, there has to be a Judas swing. Think about it. It has to rally, or you can't take the trade. So we have a short-term high. Price rallies through it. All of a sudden, you're on sell mode. You have a sell signal now with the weekly bias being bearish. So you drop down the hourly chart and you look for an hourly high to be breached. And you sell short on the hourly chart. Short-term high here. Okay, price is rallying through it. When it does that, you look for the same thing to occur on the hourly chart. That means the short-term high is going to be violated. You're entering on a turtle soup. On the setup, that same thing. It's a turtle soup on the daily chart. It's only looking for highs to be breached and sell short there. Okay. We have a swing high here. Price hits it here, clears that out, sell it. Only if it's on the hourly chart gives you the same scenario that's fractal. In other words, you're going to see the same thing occur on the hourly chart that you're seeing here on the daily chart. That previous high is being breached, and when it does that on an hourly chart and it's in London Open or New York Open, you're going to sell short. Short-term high here, price runs up through it. When it does that, you want to sell short. When the hourly chart does the same thing, it breaches an hourly swing high, you go short and enter on the hourly chart. But the setup is on the daily. It only goes down one day. Next day, it rallies up through it. In here, we have a swing high. Rallies up through it here. Right there. When it does that, and it does it also on an hourly chart, it means it's making a higher high than on an hourly basis. It turtle soups as well. Get short. There you go. We have a swing high here. I didn't note. It hits it here. Let me go back to that one. I don't know why I missed that one. Swing high in here. You'd have stops above it. Okay. Price rallies through. Trades down. Swing high here. Price runs through it. Holy shit! We took a loss. Told you it was going to come. It's going to come. How many setups paid out? Lots of them. Here's one that you would have had your ass handed to you. That's what's always going to be there. When the market makes a reversal, we had the benefit of seeing it. It had a little bit deeper retracement or reversal here. That's what's going to happen. You're going to take a loss. Oh well, it is what it is. The M&Ms swing high in here. Price rallies through it. Okay. Right there. Run through it. Okay. You want to get short? Only if the hourly chart's doing the same thing. Gives you payback. All of a sudden, now you got a winner on the heels of a losing trade. Imagine that. We have another swing high in here. Price rallies above the high right there. That's a turtle soup on the daily chart. That's your trade pattern. Or for this example, if that's what you're trading with. There you go. You're trading right in there. There's your trading entry pattern. You go into an hourly chart. If it gives you a turtle soup sell or a higher high on the hourly chart, you sell on the hourly chart as your execution time frame. Your stop is worked out based and relative on the hourly chart. Price trades down. Another winner right there. Swing high in here. Eventually gets violated here. You would have got a loss on that one. We have a short-term high right there. Price eventually moves above it right there. On the hourly chart, you wait for the similar thing to occur. Turtle soup. You want to sell the high on the hourly chart. Price trades down. Okay. And then we move out to an area where it no longer gives us a bias to work within. If you are a order block trader, you only want to be trading on bearish order blocks, because that's going to be your MO for entry, or that's your pattern if you're trading. Again, you're not trying to apply every fucking thing that I talk about. You're not putting everything at work. You only need a selection, a setup, and entry time. That's it. It's three things. It's three levels to trading, no matter what. Now, contrast that with what you're trying to do with all of my material. You're trying to have Traders Trinity, COT, market buy-sell profiles, Fibonacci optimal trade entries, bearish order blocks, bullish order blocks, breakers, mitigation blocks. You're trying equilibrium. You're trying to fucking put everything in there. And that's not what you do. And that's why the guys that look at my stuff laugh, because they think that that's what we're trying to do. That's not what I do. You don't see me put a million things on the ideas behind what I talk about. When I do my analysis and I tell you what I think is going to happen, you're seeing very little on the charts or being described. And you're attributing the fact that I'm keeping a lot of that away from you that led to my understanding about these analysis. And it's not. I just basically told you what I do. I develop a premise. What's the premise behind? It's going to be on a higher time frame chart. If it's not ascertainable on the weekly, I'm going to use the daily and then drop down from there. And it's all scalable. But for this trading pattern or trading method, we're using the weekly to give us our premise long term, because our belief is that the weekly chart is going to stay in direction one way or the other for a longer period of time that allows us a great deal of time to find a trade and develop patience. So now look at what we've done already. We used the context on how to properly look at higher time frame charts to put in a framework for us to be a buyer or seller. Once we identify what it is we should be doing, we're not flipping back and forth. We're staying on one side of the marketplace, and we're going to milk it until we are clearly shown that this is no longer in force anymore. We know when that's occurring visually on the weekly chart when that 9 crosses above the 18, and that occurs right in here. Okay, so you're going to have to take some losses in here towards the end of the move. It's too fucking bad. Get over it. Now, we talked about the turtle soup being your executable trade pattern. We talked about the optimal trade entry being your executable trade pattern. Now we're going to look at bearish order blocks. Same thing. Nothing's fucking changed. This is the same show. Bearish order block. When it hits the bottom of that up candle, there's your trade pattern. You want to get short. What? How is all these things lining up? Because you're looking at it like a professional now. Everything that you try to do as a trader with your indicators, If you don't have this perspective on the marketplace, that's the reason why they're failing you. Okay, and just for completeness sake, when we're done doing the bearish order block, okay, and we'll look for breakers too next after this one, then I'll show you indicators, and you'll see how you can properly use indicators. And it's not an advertisement for you to go and start applying indicators, but you're going to see the facade behind it and when it's failing them, or retail traders collectively, and then when it really works. And that's the part that people use when they write their books. This is where the indicator gave me the sell signal and I made 5,000 pips. I make 1,000 pips a month using the RSI stochastics overlay. Come on. So we have a bearish order block. Your trade pattern is here. You drop down into an hourly chart. We want to wait for the hourly chart to trade up into a bearish order block. The pattern is going to be fractal. You apply to the hourly chart, and then you get short on the hourly chart and frame your money management on it. Up candle prior to the down move. Rallies up. There's your trading pattern. You're going to look for the same thing to occur on the hourly chart. When it hits a bearish order block, you get short. Do your money management based on the hourly chart. Here's your range. Up candle prior to the down move. Price hits the bearish order block. When it does the same thing on an hourly chart, hits a bearish order block, you get short. Use the money management on the scaled lower time frame on the 60-minute chart. Here's your up candle prior to the down move. Price rallies up. That's the minimum we're looking for. Again, every time it's rallying up, it's rallying up, it's rallying up, it's rallying up. That's what we're looking for the daily chart. It has to rally. That's the Judas. That's the protractionary state in the marketplace. That's the sucker play. That's the premium being built in that people buy when they're retail minded and they chase the rally and they're buying near the high. This is all this is exactly how I lost money as a commodity trader. When it no longer was a bull market, okay, every time it was retracing going lower, I was buying it. And I was completely oblivious to the idea of looking at every time it rallied, it was giving me perfect sell scenarios because I didn't understand selling short. And I admit this, as a new trader, I could not grasp the concept of selling something I didn't own. But now, obviously, selling short is easy for me to understand, like anything else that you study. Okay, so we have 1, 2, 3, 4 trades. Okay, 4 trades on a daily chart. Not a lot of trades, not a million setups. Okay, but once you understand this idea, okay, you may see, if you have a basket of the majors, the US Swissy, not that I trade it, but I don't even advocate trading Swissy, but let's just say that you want to. You can look at the majors: US CAD, US Swissy, dollar yen, Aussie dollar, Kiwi dollar, Euro dollar, pound dollar. That's a nice basket to look for using this premise. You're not going to get 1,000 trades. Okay, you're going to get really nice setups that give you a great deal of framework behind them. No bearish order block in here, but we'll come back to the breakers when it's necessary. Again, no bearish order block in here that we could have traded off of. Market's rallying up. It comes up into the up candle prior to the down move. Price hits the bearish order block in here. When it does the same thing on an hourly basis, you go short, frame your money management on the hourly chart, and price trades down. And we don't have it in here. It goes beyond it, so we don't have a setup there. I think that's it for the bearish order blocks. You don't see any more forming on the daily chart. And now we're going to go back and look and say you only want to trade breakers. Okay, your setup is the breaker. All right, so we have the breaker here. We already talked about that one initially here. Nothing after that one. Then we have this one here, the down candle prior to the up move that clears out these short-term highs in here. Okay, so we know there's a breaker. Price has to hit that. When price hits it here, there's your trade setup is a go on the daily. When you go down to your hourly chart, you're probably going to see most likely a stop out in here. There's the loss on that relative to the daily chart. We have another breaker right in here, this down candle prior to the up move. Here's your stop run right above these short-term highs. So in other words, where the turtle soups occur, find the down candle that sets up the turtle soup sell. There's your bearish setup for using as a breaker. So there's a lot of overlapping once you understand what you're looking for. The down candle right here prior to the up move, when price hits that, you're looking for the same thing to occur on the hourly chart. You want to see some form of stop run or short-term turtle soup, and you're going to sell at the down candle on an hourly chart. Just like you're seeing the setup here occur on the daily chart, you're going to see that same pattern occur on an hourly chart. When it does that, you'd be selling short, and it's going to be most likely going to be in this day here. We have a breaker here. Down candle prior to the up move, and then you have another breaker right in here. Doesn't hit this one. This one here does get hit. We do have another lower hourly chart that you'd be looking for the same phenomenon. In other words, you're going to look for, on an hour chart, you're going to see this. You're going to see a short-term high and another short-term high higher than that, which creates a turtle soup sell. The low, the down candle between both those highs, okay, that's the breaker. Okay, the higher high generates the run on the stops. The down candle between those two highs, that's what you're going to aim for when price is below. Well, it has to trade below the low. So I didn't really mention that during this discussion about breakers, because if you're new, you're probably saying, what the fuck's a breaker? Look at the Market Maker series that teaches breakers. And it's on the tutorial page on my website. All right, so we have another breaker here. Down candle prior to the move up, and you're probably saying, what? Yeah, there's a short-term high in here. There's stops on that. Price runs up, hits that, has to trade below it. When it does, it comes right back up and hits it in here. Same thing's got to occur on that 60-minute chart. There's your sell. This is the only one that occurs here in all the trading patterns we've covered so far: optimal trade entry, turtle soup, and bearish order blocks. Now we have another additional trade here that didn't come by way of any other pattern that we've discussed so far. There's a breaker right there for a sell. All right, so we have, this is one you have to watch. Once it goes below it, hits it. This one here would have been a loss. Same thing here. This would have been a loss. You can see this is the reason why I'm telling you on this method of looking at price, the moving averages will not compensate for this turning point. And you can see now every pattern is failing. Every one of them. It's all in this consolidation and after the reversal. That is what you're going to get regardless, no matter what trading pattern. And it's very nice to see how all the patterns are not, they're not giving you a signal here, because it's underlying, it's reversed. It's giving you a reversal on the weekly chart. In other words, it's correcting or potentially reversing. So it goes into consolidation, and your sells are going to be problematic. Okay, we have a short-term high in here. Price rallies away from that, clearing these stops. When price trades down below this candle, which it does here, if it trades back up to it, then you look for a sell. We don't get one. Oh yeah, we don't really get one. The next breaker would be this one, and we don't get anything after that one either. Make sure you see it. Okay, from here, this is the breaker. It trades down below it. You may have gotten something on an hourly chart, maybe, I don't know. Right in here, we'll just say we lost money on that one, just to be fair. And then you have another breaker here. No, not on the daily chart. That's not a breaker. This high would have to go higher, and it didn't. And there's no short-term high inside here to base it on. Yeah, we have one here, but price had moved away from it going up, so there's nothing there. Yeah, so the down candles, they have to go below it to give you a breaker setup. So that's it on that one. So we've seen that across the a good assortment of trading patterns, okay, to what I teach, it is a repeating phenomenon that you can find consistent setups relative to this daily chart, selling only, okay? And we went through optimal trade entries, bearish order blocks, breakers, and turtle soup sells. Now, for retail-minded thinking, we're just going to throw an indicator on, and we're going to pull up a stochastic 10 period, okay? Excuse me. We're going to be primarily looking for overbought. Now again, please do not take this as an invitation to start putting indicators on your chart. I'm just giving you a view on when the market's using indicators. Well, not the market's using the indicator, but when traders use indicators, when it works and why it works. Okay. Now we've already identified areas of where price action alone gives us the setups, and we've seen the results of that. Market moving into this condition here, overbought, if we understand the weekly time frame is bearish, by itself, just overbought is significant enough to say, okay, I'm going to be a seller based on the fact that we're overbought on the stochastic. Okay, scenario here, we're overbought on stochastics. There's your return to a bearish order block. The market makes another overbought condition. Same time, we move back into a bearish order block. Market trades up into, don't know what the hell happened here. I think that's the turtle soup. Yeah, we had a short-term high in here, came up in there, hit that. And here's an overbought condition for that one. I don't believe we had anything there. I can't recall what we had here, to be honest with you, except for the turtle soup one. I don't think we did the order block on that one, did we? I don't think I did. I'll have to watch the video now, just like you, just to figure out what I did there. But we have an overbought condition in here, and that's about that. Now, if we go back and look at the stochastics in relationship to the way the indicator can be used in the right perspective, not that, again, I'm not teaching indicators, but we have the stochastic cycling back and making a high into overbought, prices making a lower high. Trend following type 2, or what is commonly referred to as hidden divergence. It was actually identified by Nick Van Nice, and George Lane gets credit for it, but he didn't discover that. So that's a ripoff on that. And George Lane, by the way, is not the creator of stochastic. He falsely claims that he created stochastic, and it's not true at all. Okay, so we have a high and a lower high with a higher high in the stochastic. And there's your trend following hidden divergence. Same thing occurs here. Stochastics makes a higher high or higher overbought reading when it makes a lower high in price. That's your hidden divergence. Okay, and then you see a continuation with the overbought theme going through. This pattern is what I used to be profitable in commodities when I was using trend following divergence. I was using this in the reverse of when the market was bullish. I was looking for lower lows in the stochastics when higher lows were forming on price, and I was buying when markets were all going straight up, and I was attributing genius to it. I was shaking my fists in the air on America Online how great I was, and my superpower was really just looking at one side of the market using oversold conditions in the 10 period stochastics. Okay, now I attributed everything to the overall oversold readings on the indicator. I'm telling you the importance of what I just showed you all through this entire video up to me putting the stochastic on the chart. That's what makes price move, what I was showing you before, that the weekly chart is implying that it's going lower because the momentum is lower, and the weekly charts tend to stay in a long-term trend for a longer period of time. Now, we have all these ideas, okay, framed out. Now, I'm just going to go real quick to where they formed. I gotta make a different color. That's not gonna work. Okay, so inside this blue shaded areas, we're going to go down into hourly charts, and we're going to hopefully see for companies. I could be here forever. This is going to be enough for now. We already know once we get down here we had problems, and we're just going to assume that we can all tolerate the fact that it's not perfect. Nothing's going to be perfect, and you're going to take losses, and this is where it occurs, because that'll permit me more time to go back out to the weekly chart and teach institutional order flow as it would be, and not rely on the moving averages. Okay, so we're going to drop down into an hourly chart, which is going to be the execution time frame. And I'm already probably going to, I'm going to have a problem, because I know once I pull the hourly chart, I'm not going to be able to pull the data up. It's not going to be able to find it. The MT4 platform is not going to permit me to see it. But I don't know, I might luck out. I think I just did. Right. Yeah, I was concerned we weren't going to see it. So good. All right, so now inside of these little blue areas, okay, this is where we're going to execute our trades on. Okay, and they have to occur in the kill zones. And when you have it in the kill zones, you're going to be able to see the top-down approach in effect in the marketplace. But we're going to apply all the other things that I talk about in relationship to market maker. All right, so in the blue area in here, while we're up in the daily setups, okay, if we're turtle soup trader, here's a high. It violates it, runs through, we can be a seller there. Okay, we have a short-term high in here, which is also a higher here, but it doesn't run through it until later over here. We have a short-term high here, it violates. Small little movement in there, we'll scratch it as a loss. Short-term high in here, price runs through it, potential sell, be a seller there. Short-term high here, stops above it, runs through it, sell. Now, what makes this one more significant than the one we did here or the one we did here? Look at the vertical lines. Look at the day of the week. This is Tuesday. Wow, Tuesday. Yeah, Tuesday's phenomenon, looking for the weakness in the marketplace. If we're bearish long term, the market's going to be predisposed to make a high during Monday, Tuesday, or Wednesday's London Open. We're going to primarily look for sells to occur that could form on Monday. Okay, so you're going to look to try to take a trade on Monday. You're certainly going to be aiming to do it on London Open on Tuesday, because that's generally when the high of the week is formed, when it's bearish. And Wednesday we can take another trade if it's bearish. Okay. Now on Thursday we get one more run up here, and then it makes a reversal. Look at the longer term retracement in here. We talked about Thursdays being a day that's classic for reversals. Tuesday and Wednesday generally make the higher low of the week, but if there's going to be a reversal that takes place intra-week, it's going to generally be formed on Thursdays. But Thursday creates a turtle soup as well. We have a high here, it runs up, okay? We're in the area on the daily chart that's implying that we're going to see the sell form. The trade signal is on the daily chart, but we're looking for these ideas to form in the lower time frame on the hourly, okay? If we're looking for, I'm drawing a blank here for a second. Say we're looking for breakers. Okay, breakers are your trading pattern. Okay, we have swing high here. Find the low, the down candle right for the up move that takes out the previous high. That's a stop run right here. Find the low in between and the down candle. When you find that, when price hits that, once it breaks below, it has to break below it like it does here. It trades right back up until here. We can be a seller. Okay, and then price trades down. Ultimately comes back and hits an area here. You will probably see a loss on that one if you didn't take some partial profits. You have to pay yourself. Okay, the down candle right in here prior to this move up here, clearing that out. Okay, the down candle is right here. Price trades below it here. That means when it trades back to it, which it does here, there is your what? Your sell. Now, obviously, I have the shaded area up here, but nonetheless, you're still looking for the same phenomenon to occur relative to that weekly chart. You're looking for the same thing. This is your executable time frame. If you're an intraday trader, you can look and see these same things repeating just on a lower time frame. Everything in price is fractal. Over here, same thing. We have an up candle. Price hits it as your bearish order block. We have a short-term high in here. There's a turtle soup. We have a breaker in here, okay, that you can trade off of. You have a bearish order block here, a bearish order block here. And again, we're looking at a lower time frame hourly chart, so your stops are going to be relative to what you're seeing here. Price trades down, gives a nice sell scenario. Bullish candle, down move, hits the order block, bearish order block, there it is. There's a short-term high here, there's a turtle soup right there. There is a breaker that did not get hit here, never came back to that one. We do have this breaker in here. And that did not give you another entry or retest back to it there. So on the daily chart, those are the conditions. We have turtle soup here, bearish order block, mean threshold, optimal trade entries there as well. I was almost tempted to talk about a pattern that I never really taught, but I mentioned on baby pips, an ORO pattern. I'll just say it so that way it can drive Twitter nuts. What the fuck's an ORO pattern? Here we have another one here. We have turtle soup, swing high. Another swing high runs through it. You're going to sell on the hourly breach of this candle here. So sell short here. And we have a optimal trade entry 62. Looks like a 62% trace amount in here. 2 times hitting it. We have a bearish order block up candle prior to the down move. Does that one as well. We have a turtle soup stop run on this swing high right here. I think that's it that I can see right off the top. I think that's no more opportunities relative to the daily chart. Oh, there's one more. We have turtle soup. Price runs above previous high. Sells short on the hourly candle or hourly chart. Once it runs through that, you're going to go sell short there. Now, you're probably thinking, well, look, what's my stop going to be? What's my profit objective? What's all that business? Until you start seeing the formations like this, you're not going to have enough behind your study, and you need to be studying it, not trading it. Because I already know some of you are like, fuck this, I'm going in there this week, I'm trading. No, you're not. You shouldn't be doing it, let's put it that way. You probably will, but I'm telling you not to do it. The high here is rated. Okay, as soon as it raids above that, okay, it runs above it. This high is 146.52. So that means it's got to trade what? 146.60, because it's got to be at least a 10 pip run. That's the stop run we're looking for. The high over here, I'm not even going to use the highest one. I'm just going to use this one here. The high in here is 146.68. The ultimate high on this entire block of price is 46.71. 46.71. So if we're shorting around 146.60, that's only 11 pips drawdown. Wow. Yeah, so that's what I'm trying to explain to you. You don't need to have an ultra huge, big ass exposure to risk. You're not getting 1,000 setups because you're relying on more choice conditions based on the higher time frame, weekly and daily. Here's where we're using the hourly chart to highly select specific trading entries. Now, what day of the week is this? It's Thursday. What are you actually seeing there? A reversal. It just happens to be the weekly high, which we'd expect also, like I told in previous teachings. We have a nice low on Tuesday. It's not the low of the week. The low of the week is actually formed on Monday. We're not counting Sundays because Sundays are non-trade days for us. The low of the week is on Monday, and the contrary side of that weekly range, the highs formed on Thursday. And then we come off the high on Thursday and trade into a lower close for the week. The double lines delineate the new Sunday. And I think that is the last one. We don't have any more. Yeah, it's the reversal there. So now that's how you can take the weekly down into the daily and look for daily setups using all the things I talked about. It's a complete trade selection and signal method. The entry is the same thing you use on the daily chart. Whatever gets you into the trade setup on the daily, you're going to use that same thing to get you in on the trade on the hourly. Now, I'm going to tell you, and you probably already noticed by watching this presentation, the ones that make the most trade setups that still are inside these ideas of efficient trade setups. In other words, you're not getting 1,000 setups, but you're getting really nice setups. Signals are there. They're highly probable, which is what we're looking for. But the one pattern that I like the most that you see every single time we went into these little blue shaded areas where the trade signal sets up, every single time there's a turtle soup. So what's my trade pattern of choice? It's a raid on stops. Go back to Baby Pips in 2010. That's the first thing I taught you. If you've been with me since 2010, the first thing you need to identify is where are the stops. Because if they run those stops and you have a directional premise, you have a complete trading system. It's that simple. It's that simple. If you miss the stop run, look for the breaker. Think about it. Now, I didn't go down into the daily being the higher time frame, the hourly being your setup, and then a 5-minute being your executable time frame where you actually take the trade. But I give you that as homework. Do that with any one currency, pick it and go through it just like we did here, and it'll give you a whole shit ton of trading setups, lots of them, and that's day trading. These are short-term, 1 to 3 day setups, and if you're really catching a winner, you can leave a piece of it on. You're going to take half the position off at a logical level of profit taking, and that's going to be relative to we're at market current price action now. When I just did that, I didn't want to do that. I apologize, but we'll just continue the conversation from where we're at now. The method, if you drop down using, instead of the weekly chart, we're going to use the daily chart. So that's going to be your higher time frame trend direction. In other words, whatever the daily position is, and let's go back out to a daily chart, and then I'll go back out to the weekly and teach institutional order flow. So in the daily, okay, remember we had the moving averages on the chart earlier. When we moved from the weekly chart down to the daily, I gave you the 18 period. So 18 period, simple. And then we're going to do a 9 period, simple. Okay, and when we see the daily chart doing this, okay, when the daily chart does this, we get a completely different perspective. We're going to take all this off because now these are trade setups that are relative to the daily with the weekly trend. Okay, when the trend on the weekly chart is down, that's what those trades are the ones you're going to be ferreting out. But when the daily chart has environments like this, we have a totally different animal. There will be some overlap, but not a lot. Right there. Okay, so now I'm going to drop down into the hourly chart, because that's going to be our trade signal time frame. Let me think, where is that to be at? Okay, so all inside of this shaded area, if you're a day trader, okay, the premise is going to be you're going to be looking for the trade signal of your choice, whether it be a turtle soup, an optimal trade entry, a bearish order block, a breaker, whatever trading pattern that you see easily, whatever that pattern is that I teach, or if you want to stick to retail trading, overbought conditions and bearish diversions, okay, that is what you're going to be focusing on here. So inside the shaded area is what we're focusing primarily on, sells only for day trades. Day trades, not weekly holds, not 2-3 days. It's day trades. Simple as that. That means you're in the same day and out the same day. We're going to take the moving averages off because we've already identified the long-term premise relative to the daily chart. That's all you need to be a day trader. Now, to be really good at day trading, if you apply rather the weekly chart information, then you'll get really good day trades, because you'll have 2 higher time frames behind you. But just for day trading purposes, intraday, you really don't need anything more than a daily chart, because you'll have everything you need. So what we have here is we have the range to work within for going short. So every time the market moves into an area where we can be a seller, I'm going to zoom in a little bit more. Okay, your trading pattern is going to be what? Well, I'll just stick to bearish order blocks just to make things easy and move things along. Okay. Up candle prior to the down move, price hits it, be a seller, day trade, sell. What are you trying to get? I don't know. What are you trying to make? Is 15 pips about right for a day trade? I think that's fair. You're not getting overly ambitious. Up candle prior to the down move, price hits it, sell short. What are you trying to make? I don't know. What are you trying to make? You're a day trader. Find the stops below the marketplace. Okay, this is ATM. Here's the bearish order block. Price comes down. Okay, then it runs back up to the bearish order block we just showed. Okay, when you sell short at that point right there, okay, let me go back so I probably didn't do that appropriately. Up move prior to the down move. Price hits it, goes short. Where do you take your profits at? Use the ATM method I was just talking about. There's a million trades here, Michael, and it's all losing. There's some winners in there, but it loses more than it wins. You're not looking at the right context. Watch. There's where your stops are. The market's going to go where the liquidity is. The market's been rallying. This is where you're going to sell, because you're lining yourself up institutionally. Inside this green area, that's where you want to be looking to be a bear only. You're not trying to buy. So if you get a sell signal, okay, you're entering on this setup right here. The hourly chart gives you the setup. You drop down into a 5-minute chart for execution. Your stops are going to be fucking way small. But what's your payout when it runs down to this level here? Because your trade signal is on the hourly chart. Your direction is on the daily for day trades. So if you're selling up here, entering on a 5-minute basis of what? 5-minute bearish order block. A 5-minute turtle suit, bearish. A 5-minute breaker, bearish. A bearish optimal trade entry, a bearish divergence in a stochastics, a bearish whatever it is that you come up with, whatever your trading pattern is, you do it when it does this. Right when it hits that, that's when you execute on your lower 5-minute time frame. But it has to be the pattern that you trade off of occurring on that 5-minute chart. You just simply don't trade because it hits here, because it has to have a little bit more range maybe. Okay? But when you get short there, what are you taking profit at? Below the swing low prior to where it formed a signal, because the market's going to reach for that liquidity. Bingo. And then what does it do? It rallies again. Exactly what you're looking for, right? Just like it does here. Hits it below here. It rallies up just like it's supposed to. You have to wait for the sell to form after the rally. It's got to rally up. This is the Judas swing. Just like this is a Judas swing. There's a Judas swing. Here's a Judas swing. You're selling the rallies. That's all this really is. But I've defined it where you have no excuse now not knowing what is selling in the rally. How do you know the rally is something you sell? What if it's not a move that keeps going up? You don't know that. Just like we've shown, when the market reverses, you're going to get caught. There's no reason to be afraid of that, because you're going to make a whole lot of trades, but you're in sync with the institutional order flow by trading like this, using the higher time frame premise and applying it to lower time frame entries. Okay, bearish order block. We're going to use this one now. If you don't fucking start making money after this video, I'm going to be highly offended. Up candle prior to the down move. Price starts to rally up. That's what you need, because this is your hourly chart. This is your trade signal time frame. The daily is your directional premise. You're going to be what? A seller only. Inside the green area, this is when those moving averages on the daily chart were 9 below the 18. When it's like that, you only look to sell. Okay? Bearish order block. Price runs up, hits it, go down to a 5-minute chart, look for what? A bearish order block inside of these wicks right in here. Right in here. Go into your own time frame. I'm not going to do it. I'm not going to do everything for you. Go into the lower time frame, 5-minute chart. You're going to see a bearish order block on a 5-minute chart, and you sell at that one, and you got fucking lock, stock, and barrel, the tightest entry point you're going to fucking ever see. What are you waiting for when you get into it short? A run below the stop right here. That's where the market's going to reach for liquidity. That's ATM. Getting short, you don't get out on a 5-minute profit objective. You get out on the hourly chart because that's where the trade's set up. And the liquidity below the swing low on the hourly chart. Price comes down, hits it, hangs around, and does what? It rallies up again. What the fuck's it doing that for? Well, look closely. There's your bearish order block right here. It's got a lot of wick, so you go to the body, but trust the low as well. Okay, don't worry about it. It's not that big of a range. Look over here in price. It's not going to fucking make or break you. Okay, unless you're over leveraging 30%. Don't do that. So here you have a swing low right there. Okay, so here's the high. It runs down away from that, and it makes a swing low, and it comes back up. The liquidity's below this low here. Okay, sell short when it hits that. Look, what am I trade off of? 5-minute order block. 5-minute turtle suit. 5-minute optimal trade entry. 5-minute bearish order block. I already said that one. Anything bearish that you use as a trading pattern, that's what you do. Okay? You also have a short-term high being violated here, which is a turtle suit. That's the powerful setups that I teach you. Bearish order block that runs a swing high into it. That's the ones that work. That's the most powerful technical price pattern you're ever going to fucking see. Jason Stapleton, you don't know shit. Okay? Steve Morrow, you didn't learn everything from me. Martin Cole, I ain't going to fucking talk about you. You're a clown. Everybody else that teaches price action, okay, if they don't teach this pattern here, okay, Gartley is essentially what it is. But the problem with Gartley is when do you anticipate a Gartley forming? If it is not predisposed to occur, you're going to get wiped out. It's going to run right on through it. This is how harmonic patterns work profitably. But expecting harmonics to be talked about here, huh? I'm showing you how to look at price correctly. And then if you apply whatever trading discipline you apply for trades, if you use it like this, it will suddenly start working for you. This is the missing link to everybody else's trading. Understanding institutional order flow. Understanding where price is going to go. Higher time frame is going to dictate that, not the lower time frame. So when price hits this, what are you looking for? You're going to take liquidity out right here. Maybe I can leave a little bit on, not just trade here. I got to think in terms of time of day, right? I mean, you're getting in at London. Why would you just take a short-term objective here and not hold for the whole daily range? Wow, now the gears are starting to turn. You see? When you start applying all these things in a concerted effort, then all of a sudden you start getting a lot more appreciation for what you've been learning. All right, so price rallies up again, goes up into bearish order block. The big beefy candle is what you're looking for right here. Okay. Price hits it. Where's the liquidity at? Right below here. Hits it, comes down. You got a little bit of paper profit, then you don't have much. But you do have something on the table you can clean off because of the day trade. So you have to get paid. When it trades down, what's it trading down into? See that? Down candle prior to that move. That's a breaker, but it's also an order block, but it's bullish. When it hits that, you got to take something off there. But ultimately, you would take something here, but you'd leave something on expecting this to be ran out. It doesn't give it to you. So you get something off, but nothing else happens. Excuse me. All right, say here's your pattern for a turtle suit. Okay. You have a high here, price runs through it. You can go down to a 5-minute time frame for execution. You may get something in here. What's it reaching for? Liquidity right below this swing low. All of a sudden, amazingly, all these types of trades jump off the chart. Now, we're only specifically dealing with day trades here because I've already shown you the model for short-term trading using the weekly, the daily, and the 1 hour. Now we're talking about day trading, so it's the daily chart giving you the directional premise, the hourly, what we're looking at here for the trade setup or signal, and then using the 5-minute for execution. Okay, we have price making a move away from that. We're going to use the up candle in here. Big beefy body candle right in here. When price hits that, you're looking for a bearish order block to be traded to on a 5-minute basis. What are you going to be reaching for? Liquidity below the swing low. So in here, it would have to be here. You're going to have to blend all this gap in here. So that would be right below here. So getting short here, you're going to take some profits, but also being mindful that you are a day trader and you're using time of day. You're going to get out between 10 o'clock and noon New York time. I probably should have been saying that all along because this is now a day trading model. All right, so we have price route. This is a Monday in here. Price moves away from that high. Look in here. What do you see? This is an hourly chart. The ultimate high candle is right here. But this candle here and this candle here, all this together is what? 3 hours of time. Was there any down candle or any bearish movement below or between these two candles? No. So where's the order block? Is it here? Or is it in the middle of this candle? Or is it the low of this candle? Because if I had the capabilities of showing a 3-hour chart, this entire range of this hour, and this hour would all be representative of an up 3-hour candle. And then you would see the down move here. So the order block begins with this low here. That's not the first time I talked about that. You go through my stuff, you'll see it. The order block is here. Okay. Price trades through it, comes back, hits it here. What's it going to aim for? The liquidity below the swing low. Take some profits when it does it here, but that's early in the day. You hold for what? 10 to noon in New York time. That's London close. Ideally, you want to be taking something off between 10 o'clock and 11 o'clock in the morning New York time. Price comes down, has a nice, really nice move there. Okay. I'm going to kill it from here. There's plenty of other opportunities in here. You can see other examples, turtle soups and optimal trade entries and such. But as the price moves and makes all these, here's a breaker, optimal trade entry, bearish order block, breaker, bearish order block, breaker, turtle soup. We have a high odds bearish order block trade. Hits the bottom of this candle here, clears the level, stops, hits it right here. There's a nice sell-off, runs for liquidity here. Everything I'm showing you here is a framework, okay? And it's important that you come away with, hopefully, a greater appreciation for what you're learning and in how to apply it, and not just, let me just do this, it's a lot easier. It's important that you have the frame of mind like I'm teaching here. And I thought by using Alexander Elder's book, Trading for a Living, Triple Screen, using that approach and how I used it coming up as a trader, that built me a very quick way of doing top-down analysis. It gave me a framework to work within. Now, because it was a bullish market and I was only focusing on buys only, I was making crazy fucking money. That's the secret to me taking $2,600, losing half the money essentially on my first orange juice options trade because I didn't know what the fuck I was doing. And then after that drawdown, I took that amount of money up to $832,000 in 9 months. And I'm telling you, it was all attributed to me being lucky, trading long only, but doing what I just showed you here earlier. I was using the stochastic that were sold and trend following and bullish divergence only. Now, I can tell you with honesty, it was complete and utter luck that my first year of trading did that. But the problem with that is that's what occurs many times with new traders. They get in here and they'll get lucky initially, and they will attribute falsely that they have a greater understanding of what it is that's going on in the marketplace, and they have no fucking idea. You can be fooled for a long time that you think you have skill and you don't. And I'm a prime example of that. Because the first year, I got real lucky after that losing trade on orange juice. And I parlayed that money up into, by all definitions, a small fortune. Now, back then, that wasn't a small fortune. That was a shit ton of fucking money. So much so that I was like, I'm done. I'm not even going to work anymore. And I did the classic thing. I quit work before I knew what the fuck I was doing, before I was capitalized properly. And you're probably saying, well, that ain't properly. No, it's not properly. Because I was spending money. After I got $832,000, I was spending tons of money. When you make $17,000 a week consistently, it goes to your head. And as a young man, it went to my head. So the takeaway from that is, as a mature trader looking back, I can honestly say that I had no idea what the fuck I was doing, and I got lucky. And how I got lucky, I can explain how that luck occurred. But the flip side of that is, it teaches that if you do understand the right side of the marketplace on the higher time frame, you can make a fucking ton of money and milk it all day long. You'll know exactly what you're looking for. There won't be any ambiguity. There's no proof in this ITC shit making any money. Show me proof of traders making money. I'm seeing a lot of that stuff, and it's probably the same two fucking dickwads. Bottom line is don't worry about what everybody else is making. Test this stuff. You put it to a test. Really, really, really try it. Not just do partial back testing with half of the information. Go in with all of the information and really make a go of it, and try to do your best to shoot it down. You're not shooting me down. I'm already fucking rich. I'm already made money with this stuff, and I'm still making money with it all the time. I want you to shoot down the ideas and the principles, because you won't be able to. By default, you're going to be converted, and you'll start doing the same thing that all of my trolls are using this stuff. All my trolls use my shit. They still talk shit about me as a person, but they don't have anything to say about the tools. The concepts work because it's the truth behind how the marketplace works. Now, I said all that to say this. There's no fucking excuse for you not to be profitable. Zero. You have zero excuses now. Where are you going to mess it up at? Not staying inside the rules. If you have a clear determination to be a buyer or seller on your higher time frame chart, if you deviate that and you go against it, you're going to lose money. And you're going to know now why you lost money. You're going to miss trades because there's going to be big moves that goes against your higher time frame selection. You're going to develop a premise that you're going to be a buyer or a seller, and it's going to take a lot of patience to stay on that one side of the marketplace, because there's going to be all kinds of little pops that go against you in that time frame or that direction, and you need to let it go by. Major league players that play baseball, they don't swing at every fucking pitch. But yet, look at them. They're making more money than you and I do every year. These guys make millions and millions and millions of dollars every fucking year. And they're not swinging at every fucking pitch. They should be fucking fired, right? If your mindset as a trader, you should be taking every trading setup. No, you shouldn't. You need to be able to filter them. And that's what these major league players do. They filter these pitches. When they come down in a microsecond, their brains are saying, this is the one I'm going to swing on. And the ones that get emotional because the pitcher just hit a batter, he's fucking pissed off. He's going to try to knock that fucking ball down his throat. And all of a sudden, the process is thrown right out the window, and you're emotionally doing what? Swinging at every fucking thing. And you strike out. Don't be surprised that's what happens in your own trading. You're going to do the same shit. So, when you're looking at institutional order flow, let's go out to a weekly chart. And we'll wrap this up. I know, all good things have to come to an end. When we look at institutional order flow without the moving averages, okay, let me put them up for completeness sake, because I want you to see the difference in having them on your chart and in not having them. Good grief. Alright, so we have this area in here where the moving averages cross over, okay, and they cross back above right there. So inside the yellow area, we're going to use yellow this time, fuck it. This is the area in which you want to be a seller only, okay? Now I'm going to take the moving averages off because it's not important that we have them, but I'm going to show you what you're going to eventually graduate to and why you won't need these moving averages. Like, I don't put them on my chart. Excuse me, I don't put these on my chart anymore. I know based on what I'm going to show you here what institutional order flow is. Okay, let me zoom in a little bit. Let me go one more time. All right. Inside of this yellow box, okay, I want you to think about all the tools that I've given you in Market Maker and in Precision Trading Concepts and in Sniper Trading. Forget moving averages, forget trend lines, forget harmonic patterns and classic chart patterns. Forget that. Think, what is the price doing? We had a range where it moves down quickly. It comes back up to that range, fills it in, only up to a point at which the up candle formed. Then it respected it. If it goes lower, where should it go? Below the swing low between where it's at now and the old range high. There's your swing low. Price does what? Goes right down below it. Okay, so know that what's happening. The market's seeking liquidity below the marketplace. Right there, that's all you need. It's over. It's done. Market structure is bearish. See how different that is? I don't need moving averages to cross over. In fact, I already know that market structure and the institutional order flow is likely to go lower. Once we see the market move from this high here down low, when we see this candle right there, it's violated market structure right there. And this swing high is, I'm sorry, it's the swing low as well. So we've seen what? The market break down. So now we're going to be seeing what? The market rally on this time frame, the weekly chart. Every time it rallies, it should go up to an area of institutional order flow. That means what? A bearish order block, a breaker. It's going to form a turtle soup likely. Not so much on the weekly chart, but these are the same things you're looking for. But what it's telling you is the market's going to keep seeking liquidity below where it's at right now. That means every time you see a swing low, it's going to seek that. It goes up, okay, closes in the range. It's going to drop likely from there and go right down below these lows. And it does that right there. Then it starts to rally up again. Well, what's it doing this for? It's going up to trade back into this bullish candle, which is the bearish order block prior to this big move down. As it's rallying up, where's the liquidity at? Below this swing low on the weekly chart. Right there. Okay, market goes up. Look at all the time it spends right at the body of the candle, right there on that bearish order block. It spends 4 weeks before finally expanding and shows range expansion to the downside, reaching for the liquidity below the low on this short-term low. And then what does it do? It rallies again. Where's it rallying up to? The up candle prior to the down move. It's recapitalizing, okay, an area where they sold before. What's it going to reach for once it does that? Once it goes up here, it's going to reach for the liquidity below the swing low. Boom, it hits it again. Well, shit, this is pretty strong when you start thinking about it. You know, without having any moving averages, what the market's trying to do. It's seeking liquidity. So if it's seeking liquidity like this in this small little section of price, don't look at price like a fucking binoculars right up on the screen of your computer. You got to get some distance between you and price. So scroll out. So back here, all in here, it keeps seeking liquidity and it keeps taking liquidity. What's it really reaching for? The liquidity below this low. Wow. Think about it. When the moving averages are crossing down, you don't know just because of the moving average what it's reaching for. It's going lower. But when you understand where the liquidity is below the marketplace, then suddenly everything starts to take shape. Keep scrolling out. There's a swing low it's reaching for. That's lower than this one. We have this area over here that price is going to reach for in terms of liquidity eventually, right here. And you saw we just did that with what? Brexit. So now think about this. When you look at price, you don't need indicators. You don't need trend lines. You don't need moving averages. You don't need that. But initially, in the beginning, the moving averages will help you. It will give you the right thing to look for the majority of the time. But it's going to have gray areas where it's going to hurt you. Towards the end, right when the reversal takes place, you won't understand what's happened. But when you understand what we're seeing here, and we go back in our videos, okay, well, my videos, not your videos, but when price sweeps below this low, okay, go back and see if I didn't talk about that specific area right there being a potential low. And you're going to find that I did. And it's all going to be based on the fact that we swept this low here. And every time it sweeps the liquidity below these short-term lows, the next retracement occurs. Ooh, think about that now. Every time it takes liquidity out, okay, and you'll expect a retracement. But then think about it. When it takes these lows out, everybody else is thinking it broke out to the downside and gets short. Institutions are going to cycle it back up, build in a premium to get people chasing it there. And then there's your swing high that forms. Then price sells off again, and it goes and expands to the lower downside, absorbing liquidity below the marketplace. Pairing orders. Where's the market reaching for? These are all the themes that I've talked about for 5.5 years. You guys are seeing it on a weekly basis with me giving my analysis, some of it in trade, some of it in just analysis and commentary. But every single week, the markets are doing exactly what ICT says. It's unavoidable, because I have submitted to what the market tells me based on everything I've shown you tonight. These are all the framework in which that I use internally in my head that makes these ideas come to the videos that you hear and see. It's not voodoo. It's not copying somebody else's discipline or trading concept. It's just understanding what the market is telling you. And who drives the marketplace? The banks. If the banks can't hide their footsteps because they're so big, they're so massive, they're never going to be able to hide what they're doing. There may be things like the depegging of the Swiss against the euro, and we saw what we did last year in January 2015. And then we see the Brexit occur here. Okay, I can hang my hat on and say I was right about them leaving, and that we're going to see the big smash down here. It went to 150 and sold off and blew out all the lows out. And I was calling it every time it before it did it on Twitter. You know, I did all those things. I'm the only one out there that did it, and I can fucking brag about it. And fuck you if you got a problem with it, because I did it. No one else did. Show me the person that did it specifically, like I did. I told you the levels I was reaching for every single time, and it hit it. Boom, 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 boom. And when it made the low, I said, there you go. There's Armageddon. And then what happened? The market came off the low. Why? Go into your fucking charts and you'll see why. See, I can be arrogant because I've already arrived at what everybody else is aspiring to. When you submit to these ideas, it will take very little time for you to advance in your understanding. Your trades will be fucking well beyond what you ever expected them to be. They'll be more precise. You'll be more specifically focused on criteria that gives high probability setups. The definition's not changing. It's not shifting in and out. You're not trying to apply 50 ICT concepts. You're looking for a selection. Buy or sell. It's got to be hinged on a higher time frame chart. That part is unforgivable. You have to stay within that scope. Choose your time frame on the higher time frame and live there. That's going to be your buy or sell. Your trade signal occurs on a lower time frame. Whenever that trade pattern occurs there, you drop down into your execution time frame. It's that simple. And I got the idea from Alexander Elder, from the book Trading for a Living. That's why I tell you, he's one of the mentors that put his fingerprint on me. Would I have eventually gotten to understanding this Yes, because Nick Van Nice took what he learned from Alexander Elder and he made a complete trading system out of it. And he called it the CTS Trend Selector. The weekly chart was based on the 18 and 9. The daily chart was the 18 and the 40 moving average. And on the hourly chart, it was the 18 and the 9. That's all it was. And he would list every market that had an interest in trading. It was every major commodity. And he listed it whether the weekly chart was bullish or bearish based on what I just showed you with the moving averages. Then he showed what chart on the daily time frame, what markets were bullish or bearish relative to that. And then the hourly chart, the intraday chart, what the averages were implying there. And if you had a down market on a weekly and an up market on a daily, that was a swing trade condition for a sell. Ooh, that's the same thing I just taught you tonight. If the weekly was down and daily was down and the intraday was up, that was a day trade for a sell. Wow. So he quantified trade trending. What the fuck, Michael? Trend trading. Okay, dyslexia. The premise of mathematically defining trend. So that way it gave traders like me that was new, had no understanding what the fuck I was doing. It gave us an objective way of quantifying whether the trend is bullish or bearish. It doesn't matter if it paid out every single time bullish or bearish and paid out profitably. It gave me a context to work within. And then I took that same approach and I taught people in America Online the same thing. And before CTS Trend Selector, Commodity Trend Service, rather, the application that he eventually moved to using stocks with that same thing. And this is what got him in trouble because he was using things that he supposedly would have made money on, but he was using it with the commodity market. The CFTC smacked him for that, and they put him out of business. I was already doing it with stocks because I had Metastock, and I would just compress all the reports that Metastock would do, and I would quantify every stock in the Dow 30, the Nasdaq 100, and the S&P 500, what stocks that were weekly bullish, daily bearish. Then I had a swing trade set up, and then I would look for Dow theory to support to buy, and then done. I was buying stock options and making fucking all kinds of money, and that's how I became a stock trader. Didn't trade the shares, I traded the stock options, and I understood once that Nick Van Nice from Commodity Trend Service started doing the stock options. Then he started doing his cover on put to call ratios. And if I was looking to buy long call options, I wanted to see when calls were undervalued and puts were overvalued. And that's kind of complicated. I can't do that here without actually pulling up all my other stuff. But there's a way of qualifying when puts are overvalued and when calls are overvalued, and vice versa when the options are undervalued, and it relies highly on your understanding of implied volatility and historical volatility. If implied volatility drops below historical volatility, generally options are undervalued. But if you're bullish and you have a long basis on the marketplace and you're looking at predisposed bullish stocks or commodities or currencies, then options are the best bet. Simply because the market's bullish doesn't mean buying options relative to direction, like long calls if the market's bullish. That does not mean that that's going to be a profitable venture, because you could be buying options when implied volatility is above historical volatility. That means all of the Greeks that are behind option pricing are going to be in inflated pricing. In other words, you're going to be buying an option that's already overvalued. And even though the market may be moving in your direction correctly, your option value will be decreasing, which makes very little sense to a new trader like it did for me. But when I understood all the Greeks behind it that makes up option pricing models, it makes perfect sense. So you have to understand there's a lot to do when you're trading options. It's not just simply looking at the market itself. And that's why, you know, a lot of people trade options and lose money because they don't understand the Greeks behind it. And they can be right on the direction, but it doesn't mean they're going to be profitable in their options trading. But I'm going to close it here, guys. I'm parched. We've been going at it for 2.5 hours. I was aiming for 2, so I went over a little bit. But I am confident you've learned something tonight that will give you a very big push in the right direction. It's probably answered a lot of questions for some of you. It probably created a lot more questions for some of you. But there's no excuse why you can't go into the marketplace on a daily basis and study with these ideas in mind, and have a constructive study about it. It'll build more experience in your price action trading. It'll build uh, a lot less confusion, because you'll know what it is what you're supposed to be looking for. And now you have context to work within. It gives you a way of going right into the charts. It doesn't matter what asset class or what pair you look at. If you break the market down like we just did, and it's just using the model that is used in Alexander Elder's book by using 3 time frames. That's all it is, multi-time frame trading. It's all that is. But at the time, when I first looked at it, it looked like fucking voodoo to me. I was like, wow, this is incredible. It's the same thing you guys tell me. This is crazy. I've never seen anything like it. Yada, yada, yada. And I admit, all the things that you're learning in terms of the market maker stuff, that is unique. There's nothing else out there like that. But the same responses you have is the same thing I had when I was looking at Alexander's book. I was like, wow, this is revolutionary. And I will tell you this, it was revolutionary. Because when that book came out, it influenced everybody in trading. Everybody has that book on their library. If they're a trader of any measure in terms of worth, they either read that book or they have it in their library. And that's one of the gems that's out there in literature that for a trader, you should absolutely have it. I know some of you are going to ask, what about Welcome to My Trading Room, or Enter My Trading Room, his secondary book. I read it, and that's not, we'll just be respectful, not say nothing bad about him. Trading for a Living book is good. The psychological aspects behind it, not all the indicator bullshit, but the triple screen approach and the psychological aspects of that book, absolutely worth it. Absolutely worth it. But that's this month's introduction for a trading concept that you can apply for the next 4 weeks, and then we will go into it again. We're gonna have to say this one is for the whole entire month of July, and then we'll use the first weekend of August. We'll do another one then. So that's the next timeline when we do another trading method, top-down, building an approach to going into the marketplace. So that way, it's not just ICT this or market maker that. It just gives you a way to go in and actually take trades. So with that, I'm going to wish you a very, very pleasant evening or morning if you guys are over there in Australia. The feedback, I hope, will be weighed, okay, in an objective manner. Don't think that I'm trying to teach you a panacea, be all end all. Again, these are all foundational. They're all meant to get you started on the right foot, and then you will advance in all the things that I talk about, and you'll start applying things to give you greater understanding of what the market's going to do. And when you understand those things, you're unstoppable. You're going to be absolutely what you want to be in terms of a trader, and you won't ask other people what their opinions are or what their opinion of your trading results are. When you get to that point, you've arrived. So with that, guys, I wish you good luck and good trading.